What is up, everybody? My name is Sean Grapevine, Director of Agent Direct, and you have joined us here this Monday, as with every Monday, for the Monday, believe it or not, Market Update. I am joined here again this Monday, as with every Monday, for almost like 9 months now, maybe getting close to our first year anniversary here. I am joined by the Sultan of SLAs, the King of Collateralized Debt. He's the Colossus of Credit. He's the Titan of the 10-year. He's the Great Bambino. Unlike some, he matches his asset durations to his potential currency outflows. Looking at USVB. For St. Patrick's Day, he made sure all our MBS prices showed in green. And like Jerome Powell at the helm of the USS Money Printer, he makes available cold, hard American liquidity in the choppy waters of the sea of volatility. And in a fit of generosity and goodwill, he tilts the last sumptuous droplets of product optionality to our dry lips, which have grown chapped from our constant battle against retail lenders and stubborn agents. That's right. He needs no introduction, but he got one anyway. It is Austin Koenig. Welcome, Austin.
Thanks, Sean. That was really great. I think it was one of the best ones we've had in that past 9 months. One of the best introductions. So I appreciate the hard work you always put in that. Thank you as always.
You're welcome. You're welcome. Well, let's see. Since we last spoke, speaking of the captain of the what did I call it? The USS
Money Printer, I think is what you said.
Yeah. Well, it's not working. The USS Money Printer are not working in our favor like it was in 2020 and 2021. Tell us about what Mr. Powell had to say for himself on Wednesday, and catch us up on last week's news.
Yeah, of course. So I think last week we had a lot of drama with just continued bank pressures that we've seen throughout the markets in the past couple of weeks, right? So the market would have days where it's risk off, and stocks are rallying, bank stocks are rallying big time, and we'd see yields rise, and generally we'd also see then a huge flight to safety, flight to bonds. Bond yields come down, bond prices go up, stocks coming down. That was kind of the theme on Friday, and obviously after our Wednesday meeting with the Fed, we had a 25 bip hike. We're hitting that rate of 5% here for the Fed funds on the high end. And generally what I'd say is there is not really a huge perfect equilibrium where the market is understanding exactly where we're going to go in the next couple of meetings. I think there's a lot of sentiment out there of, rate cuts can happen as early as June, or, those sort of things are going to start coming to the forefront. I don't know if we really have a clear direction from Jerome Powell, and here's kind of where I think the devil's in the details is really what people speak about, after the fact, continually reiterating like different things that the Fed is having to pay attention to when it comes to these bank pressures that we've seen, and different economic issues that they're going to have to kind of, find their way around, because, at the end of the day, the bank failures like SVB, and obviously all the issues that we've seen from Credit Suisse, even though they're not a U.S. bank technically, it's coming to fruition in terms of the pain of what this steep rate hike cycle has done to our economy and the way banks operate. And generally, I think we'll kind of have to eventually decide. The Fed will have to decide where we're stopping. And I think what the market interpreted it as is the Fed knows they still have inflation to battle. They think the job market's still hot enough. But that data we can't predict. We can't say what comes of it, how the Fed interprets it. That's still something that's down the road. The actual pressures of the failures that we've seen is something that the Fed has definitely had to readjust to. And I think just a matter of when they start cutting or when they stop hiking altogether, it's going to be kind of a sigh of relief to a lot of those market participants. But we all know that there's the inflation battle that it continues to rage on to an extent.
For sure. And it's, inflation, right? It's getting better, but not quite as fast as everybody thinks. Although, to be fair, there are not a whole lot of numbers between 2 and 6. There are significantly fewer numbers between 2% and 6% than between 2% and whatever our peak was at, 8.1, 8.4, something like that. And as slow going as the fight against inflation has been, at some point people are going to look down 2 or 3 inflation prints from now, and even if inflation's only reducing it at 0.4 per month, right? They're going to look down and say, oh, well, like, yeah, it's going slow, but now we're at 4.8%, and like, it's not the Fed's target rate, like inflation rate, but a healthy economy can be had at an inflation rate of 4.8%. That's by no means runaway inflation. So, despite the slowdown in the speed of the reduction in inflation, it does seem like, the end is nigh, right? Like as long as the numbers keep going in the right direction, enough times, like we'll get to where we want to go. Are people starting to kind of get the sense that, like, whatever the speed that we're going at, like, we are going in the right direction and we're actually getting kind of close, right? We're only 4% away.
I think generally, there's progress, right? And and the Fed acknowledges that there's been progress, but the thing is, I think they don't want to send the message of they think the job's done necessarily. And I think that's such a tricky message to convey, is like, we will step in where we need to if things really get bad, but kind of just telling the market to not price that in. And it just leaves everyone confused at the end of the day. So, what we're seeing in the market today, for example, right? We've seen we're going to have worse rate sheets nonetheless. The 10-year is, up over 10 basis points from where we closed on Friday.
When in doubt, 3.5. That's just where it's lived, on average for the last 6 months. It's sometimes a little lower, sometimes a lot higher, but it never spends more than a week above or below 3.5. That's just where it goes.
Yeah, and I think what earlier this year we thought we kind of had it figured out to an extent of like, hey, inflation's looking this hot. We're probably looking at 2-3 hikes, and then we'll stop. I think the market is just not really sure of itself in terms of exactly when the cuts are going to happen, and it really can't be until that messaging is very clear, and I think we actually see a halt or see a stoppage in rate hikes. It's at the end of the day, that's where we stand right now, and we're going to continue to see volatility. I don't think we are out of the woods on the volatility train quite yet, because we're having rates go up quite a bit today. Who's to say the sentiment shifts completely by Wednesday or something like that? And there's not really much data that to start our week here that's going to make market moves to an extent. It's just more so what's spoken, any sort of new developments that we're not acutely aware of. That's where I think we're going to see volatility get driven from, and that makes it kind of hard to operate to an extent. But at the end of the day, that's what we're given, and that's kind of what to expect. I would say for the next coming weeks is just volatility that's coming from developments that are really not so much in our control, obviously.
Sure. And here's the good news: we're setting a record lock week after record lock week, right? Like the good thing is that the American consumer, and that's really like what matters to us, right? Like the nominal rates don't matter when it comes down to it. People have about, it seems like, I think we can tell, I think like we've run a little social experiment here. People seem to have about a 4-month rate memory, right? So in September and October, when we were all feeling the pain, it's because everybody remembered, rates in the 2s and 3s and 4s from, April, May, and June of 2022. But now, like, people are just used to it. They're willing to stomach a 5, a 6, and a 7% rate, because like they just have realized that's the new normal. And I also think another good thing, right, like is you can't look at inflation in like just in and of itself and think, oh well, the cost of goods is rising. Yeah, that sucks. Okay, well, we're raising interest rates to combat that, which makes houses more expensive. That also sucks. But like, one of the stickiest parts of inflation in this round has been that incomes keep going up too quickly, right? That's like, the Fed is upset about that as much as we wish that they weren't. And so like, yeah, houses got more expensive and, basket of kids got more expensive, but they generally got more expensive because rates or, wages went up. And in some of the months we've seen wages go up faster than CPI. So you're actually seeing, I think a net net increase in buying power. And I think we're seeing a lot of that in our loan apps too, like on the ground. A lot of the people that used to apply, like the $36,000 a year salary in a major metropolitan area, it just doesn't exist anymore. All those people are making $50,000, $55,000, $60,000 a year now. That's not like out of the picture for your average American. So, I think the good news on our end, right? Like it's a little dreary out there from the inflation point of view, from a rates point of view, from a 10-year stuck at 3.5% point of view. But on our end, we've seen better qualified customers and that are getting paid more and that have that 4 to 5 month memory, and they're just like, F it. I'm just gonna date the rate and marry the house.
Yeah, I think that's what we're seeing. Here, like you said, I was actually kind of curious of what your anecdotes were from the ground level of talking to borrowers, talking to agents, talking to the other LOs, and I think we see it through the lock numbers. People are really seeing. I think purchase demand is stepped up to an extent. With that kind of, hey, this is the new normal of rates of where we're at, and we're still interested in buying a house, and this is what we can afford. And like you said, I think incomes are staying fairly resilient. I don't think it's any. It's going to be hard pressed for anyone to say they're better off than they were before record high inflation to an extent, but the incomes have kept up like at a broad level to really help stomach the blow to an extent. And that's actually kind of part of the problem, right? Is when you have that general income increase to help fight that basket of goods getting more expensive, your purchases don't really change necessarily, or your decisions. Such as services, that's probably one of the most sticky parts of the inflation picture, right? And if people are like still able to go out to restaurants, go on vacations at their normal rate or their desire based off their income, it's not really going to see prices come down or really stop raising because that demand's still there, right? So I think it's very interesting. It's kind of an interesting ballpark we're playing in with the world of economics and how it kind of affects every individual. I'm just kind of curious too, like in your area, are you seeing like a lot of home price competition and even just like buying competition? I've seen some stories from a couple of LOs here and there where they're already seeing multiple offers on some properties as well, and that's something that we haven't really thought about too much over the past 6 or so months.
Yeah, Atlanta's an interesting market. We've seen a return to what I would call a pretty healthy market. So a couple situations in really desirable areas where we have multiple offers and stuff like that. But then our like I'm looking at our MLS's stats right now. Thank you to the agent who gave me their login information. Our days on market are back to where they were in early 2020, which was right before COVID, and that was a perfectly healthy market. I mean, we weren't setting the world on fire, but like everybody's getting fed, everybody's doing well. So days on market is down to 27. So pretty normal for Atlanta in February if I look back at like historical data through this chart. And then number of closed sales. So our December Atlanta, our MLS, the Metro Atlanta one, we closed 50% of the deals that we had in 2022. So the production had been halved, so pretty scary, pretty crappy. But now in February it's at 78% of what it was last year, and last year was not just a healthy market, right? That was a crazy market in February in Atlanta. That was like at the peak of that like last gasp of craziness, and to be at 80% of that is like nobody's going hungry, right? If you work hard, there's deals out there for you, right? Not a ton of multiple offer situations, but we're not seeing reductions in prices. The percentage of original price is at 97.4. So you're seeing marginal reductions in price due to negotiations, which again is just right in line with 2018, 2019, 2020. If you go back to early 2020 or late 2022, the average price of a home in Atlanta was 102% of what it had been listed for. Crazy. So like if it stayed like this, I would be happy forever, right? Like this would be so ideal. So I think that like there is a return to normalcy, and if we see rates go down, great, more demand. It's not like there's going to be any more houses, so probably the same amount of deals. I would say that like for all the doom and gloom out there, this is honestly the best situation we've been in 9 months.
Yeah, no question. I think it also helps you as your position as a loan officer too to help with that negotiation part of it, because it's not about how much can I go over asking and the craziness of
Right.
like those multiple offers. It maybe one or two, and hey, like you have a chance to kind of really negotiate here, present the best
Sure.
deal, but what makes sense to you also. So I think it's like you said, a great happy medium, and really something where everyone can win and operate in. You do have to work hard. You can't just have it given to you like tons of refis. You have to work. But at
Most
the
of
end
it
of the
is.
day, it is what it is, and I think it's a good market for everyone to operate in. So that's awesome to hear.
100%. Well, good. Well, that was a helpful and fun conversation about the news and these my market. What's on tap for this week in terms of economic news? Anything?
Yeah, so I think really to tail at the tail end of the week, we have PCE just kind of coming to the forefront, and so that's obviously we've talked about this before. Just another inflation measure that the Fed pays attention to. I don't think we'll see too much drama from that, just regards from unless something really shocks.
Famous last words.
Yeah, famous last words, of course. But yeah, we'll see what happens from that. If we really look to the next week, I think we're going to see the jobs report, and that's going to be, I think, the more dramatic data piece. If I'm going to be perfectly honest with you, but to be perfectly frank, there's going to be things that the Fed says. I think there's a Fed speaker speaking today to some sort of press conference, and that's just going to continue to happen. I think the market's going to be always paying attention to what anyone from the Fed says, and that's going to be probably something that'll continue to drive markets a little bit. So as you kind of see those headlines come out, it could drive things. But at the end of the day, I'd say that the start of the week, at least, we have a pretty slow data release, and then we have PCA to end the week, essentially. So nothing too crazy on the data side, but that's what we got. And we'll be updating you guys as we see fit. And hopefully we can have somewhat less volatile than I'm predicting, but I think we're going to still see some volatility this week nonetheless.
All right. You heard it here first, guys. If you like it, lock it. Have a great week. Go get some deals and lock some loans. Have a great day, everyone.
See ya. Thank you.